Okay, good morning. Let's get started. Again, my name is Adam Goldstein, the Chief Business Officer at the Federal Home Loan Bank. On behalf of the bank, we welcome you all to today's webinar. Just a few quick notes before we get started. If you have any questions, please submit them at any time through the question box, and they will be answered at the end. As always, we're looking to enhance this program, the programming to our members, so we ask that you complete a survey, which will come up at the end of the webinar. We value your input and try to cater these sessions to your areas of interest. We also seek to add value to the membership by being thought leaders, educators, and strategic partners. So to that end, we encourage you to visit our financial intelligence library on our website. You can listen to podcast series on LIBOR SOFR transition. These are very popular lately. If you have not yet set up a LIBOR transition office or think you don't need one, give us a buzz. We'd love to talk to you about that. You'll find a number of publications out there, including our new Member Service Desk Weekly, designed to provide insight on current market trends and news, which we just launched recently and is available every Monday. Also on our website, you'll be able to find details on major events that management and the Board of Directors is working on together for you, our members. You'll see information on the launch of our new mortgage asset program that's set for later this year in December. So if you'd like to learn more about that secondary market outlet to sell loans to the Federal Home Loan Bank, we'd love to talk to you about that. If you are involved in the MPF program, you will need to convert over, so we definitely need to talk to those that aren't working on the application process already. You'll also see updates on the disaster relief efforts, including but not exclusive to the disaster relief funding and the Small Business Recovery Grant, which have been pretty popular. Also information on PPP loans that are eligible for collateral that you don't need to borrow against, new features in our letter of credit program, information on dividends, just oodles of really good stuff that's pertinent to your membership at the Home Loan Bank. So for today, today's webinar is about digital transformation, and this is a topic that is near and dear to the Federal Home Loan Bank of New York. We are focused very heavily on our technological renaissance, developing and enhancing our core banking system, OneLink, which I'm sure you're all familiar with, as well as a number of new member-facing systems launching later this year and into next year to modernize our technology, to enhance the member experience, and basically to serve you better. So to get into today's digital transformation webinar, I would absolutely love to do the introduction to our speaker because he's been a friend of the systems and of mine for decades. Actually started his career at the Home Loan Bank, but I promised Tom Citino, our Vice President of Member Relations, that I'd let him do it and have the honors of introducing today's webinar. So Tom, take it away, please.
Okay, thank you, Adam. So good morning, everyone. We really appreciate you joining us for this very informative session. I think you're really going to enjoy what Ray has to say. But it's really a pleasure to introduce Ray Chandonnet today. Like Adam has said, he's been a friend of the Home Loan Bank of New York and to the entire Home Loan Bank system for many years. He's a frequent speaker at member events, constantly in front of our members, offering value-added insights on banking trends and also asset liability management. He's also has been a trainer of the FHLB staff across the system on asset liability management and banking trends. So we appreciate his engagement with the system. So thanks for that, Ray. Ray, like Adam said, he's had a long career in capital markets, banking, consulting. He started his career designing enterprise software for a community bank in Massachusetts, and then he graduated to become a financial analyst and an ALM person at that bank. Ray then had gone on to work in various jobs in capital markets. Various firms included First Union Capital Markets, Lehman Brothers, JP Morgan Securities, and then also Sandler O'Neill. He also did a stint at the FHLB Boston and relatively recently at the Hovde Group. So Ray also had been a founder of bankstrategies.net, and that's a technology consulting firm to banking institutions. Currently, Ray is also a member of he's a board member of one of our member banks, Kearney Bank in New Jersey, and he chairs the Asset Liability Management Committee and also serves on the Enterprise Risk Management Committee. So with that, Ray, we really appreciate you joining us today, and we'd love you to jump right into Digital Transformation Simplified.
Great. Thank you, Tom, for that introduction, and Adam as well. You know you're getting a little long in the tooth in the industry when your introduction takes that long, but I appreciate the kind words. As Tom mentioned in my introduction, while many of you know me from the lengthy period of time I spent as a balance sheet advisor for community banks and credit unions, I started my career as a technologist in the community bank space, designing technology solutions for things like BSA AML compliance, Series E bond coupon collection, safe deposit box accounting, and the like. And I I pivoted back to my technology roots about 5-6 years ago, which is what landed me at Neokova, because it became clear to me that the challenges that the community banks and credit unions that had been my longtime clients faced were no longer financial in nature. They were more technological in nature. And so what we're going to talk about today is a sort of systematic step-by-step approach to transforming technology without taking the scare you to death risk that's involved with just ripping up your existing core banking system and starting from scratch. It's not the way the big banks do it. It's certainly not the way the fintechs that you compete with have done it. And so that's what we're going to go through with you. I'm going to start by talking about what's going on in the industry around the technology front, and then I'm going to drill into what this step-by-step approach looks like that can deliver value for you right from day one and really take most, if not all, of the risk out of the process of transforming your technology. We believe at Neokova, and I believe personally, that if you are armed with technology that puts you on par with your larger competitors, the strength of the community bank relationship model allows you to not just level the playing field, it allows you to leapfrog your competitors. And so this digital transformation process is designed to arm you with the tools that you need to really drive engagement with your customers, drive efficiencies, et cetera, in a way that lets you leapfrog your competitors. So let's jump right into it. Let's talk about first the state of the industry. It's sort of a good news, bad news thing. The good news front is we've seen, particularly during this pandemic, that community financial institutions really are the backbone of our economy. You look at the statistics around the heroism that community financial institutions showed in making a disproportionate amount of the PPP loans and a disproportionate amount of small business loans. It's very clear that community financial institutions are the heartbeat of the economic environment, particularly in small town America. Unfortunately, community harmed during this pandemic. On the other hand, there's just been relentless consolidation in the space. Why is that? Technology plays a big part of it, and you don't need to take my word for it. This is a survey that we cite fairly regularly. So in 2019, at Bank Directors Acquire or Be Acquired conference that had 600 plus senior bank executives and directors there were surveyed and asked a simple question: what do you see as the single biggest threat to you remaining independent? More than 60% of the bankers in attendance cited inability to keep up with technology as the biggest threat to their independence. You know, when BB&T and SunTrust think they have to combine forces in order to keep up with technology, you see this existentialist threat. right? According to the Bank Director 2020 Technology Survey that just came out recently, it's virtually unanimous that everybody is saying they've seen increased adoption and use of their digital channels because of COVID-19. Okay, so a really strong focus both internally from the bankers and externally from customers on technology, and yet we have a fundamental dissonance in the space around what particularly the smaller financial institutions are doing about it. Okay, in that same survey, only 21% of bank executives claimed they were completely satisfied with their core provider, and almost 2/3 of them said their core provider was really slow to implement innovative solutions. And yet, every year, only 4% of financial institutions that have an expiring contract with their core provider switch to someone else. That's an incredible dissonance when you see this sort of existentialist threat of technology and people, basically 80% of financial institutions being dissatisfied with their technology provider, and yet only 4% switch. Why? Because it's viewed as incredibly risky. And we see the same trends anecdotally in the credit union space. When we think about the legacy technology that's being used, that's driving this existential risk and these complaints of dissatisfaction, and look at it relative to what modern technology providers look like, it's pretty starkly different, right? Your legacy providers, the technology is 20, 30, in some cases more than 30 years old. You've got 5, 6, 7-year contracts with massive termination penalties, exclusivity. You're not allowed to use a third party. Their architecture is closed. It's hard to connect in a third party. They own your data. They're highly insecure. You have to have layers of cybersecurity software and people because these are very leaky technology platforms because they're old, and everything has to be customized. That makes this technology not just creaky and inefficient and frustrating, it makes it expensive. The newer technology providers that are out there, completely different technology model. It's cloud native, which makes it extremely cyber secure. Don't let the situation with folks like Capital One fool you. That wasn't cloud native technology. That was old technology that they tried to lift and drop into the cloud. So the leakiness of that old technology was still there. Your newer providers, because they are cloud native, are very highly secure, completely open architecture. You can connect anything you want. You own your data. There's no customization involved. Everything is configured by you directly. Pretty simple. The contracts are software as a service model, so they're 1-year contracts, no exclusivity, no termination fees. So very different model, both on the contract front and the technology front. Okay, and yet, those numbers I cited earlier, 80% dissatisfaction, only 4% changing contracts. Okay, and I think the reason for that is that when particularly smaller financial institutions start thinking about modernizing their technology, they tend to start with the core instead of starting with the experience that they want from their technology. Okay, and what we've learned, what I've learned is that when a financial institution comes to me and says, we need a better blank, we need a better online banking system, a better mobile banking system, a better digital account opening platform, etc. Or they come to us and say, we're thinking about replacing our core. What they're really saying, and again, the Bank Director 2020 survey really plays that out. I'm going to show you some numbers. What they're really saying is we need to deliver a better, more personalized customer experience. Over 80% of banks in that survey said that their tech strategy is driven around improving customer experience. And they're also saying our financials are under pressure. We need technology that's going to help make us more efficient and cut costs. Okay? And we see that in the survey as well. Okay? When we look at, I mentioned earlier that the larger banks have not started by focusing on their core. Okay, when you look at what the larger banks are saying they're focused on, and how they've done it, okay, they're focused predominantly on three things: data and analytics, automation, and artificial intelligence. Okay, when you move out to the smaller banks, there's much less focus on particularly on automation and on artificial intelligence. What's notable in here is that replacing their core, it's not even on the list, because they view that as the end point of their modernization. They're really focused on what we call this transformation journey that's really focused on data, automation, and AI. And importantly, the larger banks relative to the smaller banks, to go solve their data issues, to go solve their customer experiences, they're not going to their core provider. They're going to an alternative, or for the very large banks, if they have the resources, they're developing it in-house. Contrast that to the smaller financial institutions. They're reliant on the same core provider that they're saying consistently they're dissatisfied with because they're slow to innovate. So big difference in approach. Let me walk you through how they do this. Okay, there's really three primary points that I want to make here. Okay, one is that to modern your technology with this focus on customer experience and internal process improvement, et cetera, you want to end the process rather than start by focusing on the core. Okay, you want to take an approach that de-risks the process, right? There's nothing scarier in the life of a COO or a CTO or even a CEO than doing an all-at-once, what we call a rip and replace core conversion, where on Sunday night everybody's sweating while you're ready to flip the switch and hope it works. Okay, so we end this transformation process with replacing the core. We follow an approach that de-risks that process, and we follow an approach that adds value every step of the way, and so that the value that's created early on helps pay for the investments that you may need to make later on to really dig into modernizing your technology. Okay, this is essentially the journey. Okay, it is a multi-step process. This is exactly what the larger banks have done. And this is what we recommend that the smaller banks do. And there are plenty of tools and there are plenty of companies out there who can be very helpful, both with technology and with consulting, et cetera, to help smaller financial institutions walk through this process. Okay, it goes like this. Okay, if the primary focus is on data and analytics, then the first thing you need to do is what we call a scoping exercise. Okay, fancy language for figure out where your data is. Most financial institutions have data everywhere, and it's not interconnected, and it can be very difficult to get access to it. You have data in your core. Even within your core, there may be multiple silos that aren't connected to one another, right? You may have a consumer DDA or a consumer deposit module and data silo that's separate from your commercial module. You may have a lending module, et cetera, but then outside your core, you may have also many other data silos. You know, a third-party debit card processor, whoever you're using to do payments and to do wires, whoever you're using for treasury management services. You may have a loan operating system, etc. Even if they are provided to you by your quote unquote core vendor, they're not part of your core. They live outside the core. And this data doesn't talk to one another. So the first thing you need to do is you need to scope out where all your customer data lives. Okay, there's a basic mapping process that you have to go through. The next step in that process, and it's a messy step, I'm not going to lie to you, is unifying all that data onto one common data platform. You will hear terms used like data platform, data warehouse, data map. Our hardcore technology people here at Neokova say there are subtle differences between each of those. For my purposes, it's simply a centralized place where all your data is unified and mapped against one another. That takes a lot of work, but there are, again, plenty of tools and folks out there who can help with that. Once that's done, and in our experience, that's a sort of 3-month up to 3-month process. You can begin to use that centralized data platform to solve the two biggest concerns you have, which is creating more personalized banking experience, using that data to drive actionable insights into your customers, and to improve efficiency internally. Okay, so the next step that we recommend in that process is, once that data is all unified into one platform, you start using it to generate actionable insights into your customers that lets you personalize your customer's banking experience. And I'm going to show you some examples of that in a little bit. Okay, so those activities, which will lead to things like cross-selling additional products, will lead to retaining customers that might be at risk of leaving the bank, etc., will already start to generate a return on what you've done. Will already start creating value for you. The next step in that process is to use that unified data to drive process improvement. And there's a couple of places where we see that happen. One is in management reporting, right? How many banks out there? I've yet to meet a bank or a credit union that doesn't have processes internally that involve downloading data from some system into a CSV file, uploading it into Excel, formatting it nicely, printing it out, turning it into a PDF, turning it into a pretty chart that then goes into a board package or a management package, et cetera. These are incredibly inefficient, time-consuming processes. Well, once all your data is unified onto a single platform, all that management reporting can be configured so that it is literally push button. A huge gain in efficiency. And the other thing that you can really drive efficiency gains on, once that customer data is all unified, is in regulatory compliance: BSA, AML, fraud monitoring, KYC, et cetera. Okay, but once you're done with that second step, using that data to help automate processes and automate regulatory compliance, then you can start tackling your core and your so-called peripherals, which are your customer-facing technology, your mobile, your bill pay, et cetera. Okay. So what can you do with your customer data? I told you I would show you some examples of the kinds of actionable insights that you can do, you can drive once you've gone through this messy process of unifying your data onto a data platform. Well, what you can do is, as I mentioned, both of the things you want. Drive more personalized banking experience, which for community financial institutions involves giving you and your bankers incredible tools to help make them better bankers and strengthen their relationships. We're not talking about replacing your bankers, right? That's what the big banks do, right? If you're, if you're banking with Bank of America, it's hard to find a person. They drive you to their robots and their online experiences. For community financial institutions, we're talking about using digital tools to give your frontline bankers better actionable insights that they can use to strengthen how they work with your customers. So we're talking about things like next best product recommendations that are recommendations on products based on your customers' individual behaviors. Okay, so customers that have A, B, and C, 90% of them also have D. That kind of analysis, customer attrition analysis that can help you identify customers that are at risk of leaving the bank. Even if you don't measure this scientifically or mathematically, I think every banker knows that it's much more expensive to try to attract a new customer than it is to retain an existing one. So customer attrition analysis that helps you identify your at-risk customers, hugely helpful tool. Outlier analysis that looks at activity and behavior of your customers to identify when their behavior is changing and recommend a suggested reach out action to them. It could be that their financial situation is getting weaker. It could be that they have a life stage. It could be that they came into an inheritance or sold a piece of property. But outlier analysis also allows you to personalize your banking experience. And then on the process improvement, I mentioned it, push button management, board reporting, automating your regulatory processes. One of the things that you'll note is that embedded in these concepts, which I'll show you some specific examples of, are artificial intelligence tools that 5 years ago were only the purview of the big banks. That's no longer the case. These tools are available to community financial institutions. Okay, so I'm just going to run through some real quick examples here to help you visualize some of these ideas. So here's a visualization of a next best product recommendation where you may be able to look by product line. This happens to be a Roth IRA, and have your technology look at your existing customer base and which products they have and what their activity is, and recommend to you the customers who score the highest as being prospective customers for, in this case, a Roth IRA. Okay, unusual behavior monitoring. Okay, same thing. So you can have tools that look at, even on a real-time basis, but certainly on a daily basis, customer activity that deviates from their normal activity, and score them and make suggested reach outs based on these. So this happens to be unusual deposit behavior, and these two particular customers that had abnormally high deposits, right? Maybe they sold a piece of property, and we should be referring them to our wealth management person, or maybe there's some sort of fraud going on and we're supposed to alert the fraud department. Either way, it's a great tool that lets you drive a reach out to a customer. Okay, here's the attrition analysis that I talked about, where there's technology out there that lets you look at changes in customer behavior to determine who's at risk of leaving the bank. Maybe they no longer have direct deposit coming into their account. Maybe they're not paying as many bills on your bill pay. Maybe there has been a series of outgoing ACHs going to other banks. If reviewing that activity allows you to score customers that are highest risk of leaving the bank, which again can drive a reach out from a personal banker, from a branch manager, from a small commercial banking officer, etc. And finally, unifying all of that data allows you to create 360-degree views of your customers with suggested actions. Okay, so this is an example of a small business that over the course of the pandemic started seeing positive growth in their balances. More cash coming in than cash coming out. Makes sense. It's a candy company. It's a pandemic. People are eating junk food. They're drinking more, et cetera. Their balances have tripped over the FDIC insurance limit. Okay, we look at where the cash that's coming in is coming from, where the cash that's going out is going, what the trends in their balances are, and these tools are able to make suggested actions like, hey, you better go talk to this customer about a cash sweep because you're at risk of losing those balances that are above the FDIC limit. Or, hey, you may want to talk to this customer about using some of that excess cash to pay down some of their debt and refi into lower rates because, gee, you know, a fair amount of their outgoing cash flow is going on debt service. Okay. Then on the process improvement front, I mentioned automated real-time BSA AML fraud monitoring. Once all your transaction data from all your different sources that we talked about are unified, you can use affordable technology to put in rules-based monitoring that identifies transactions that are worth examining for BSA AML fraud. You can apply artificial intelligence both to identify outlier transactions that you might not otherwise have caught with your rules, and also to eliminate all those false positives that you get where you may flag a transaction, but geez, any compliance officer who knows anything about this account knows, no, this is normal behavior. Artificial intelligence can solve both of those issues. You can automate your CTR filing and your SARS filing. You can automate your case management on the transactions that really are suspicious and require coordination with FinCEN. And going forward, you're going to be able to firewall transactions from a fraud perspective so that real-time payments, as they become more prevalent, you don't have fraudulent real-time payments going out the door that you can't stop in time. All of these benefits come from unifying all your data onto the platform. And notice that we haven't yet changed the core. Okay? But we've gotten a tremendous amount of value. And here's the little secret. You're actually kind of sort of halfway through a core conversion already at this point, because all of that data mapping that you did from all your different sources to create this data platform is the process you would have to go through in order to migrate to a different core platform anyway. And so all of a sudden, it's not a fire drill to change core on the data front. That was done a while ago. And by the way, I forgot to mention, but it is a bullet in my slides. The process that I'm talking about, depending on how many resources you have internally, from start to finish, including potentially migrating to a modern core, is an 18 to 36 month process. You start getting value from it almost immediately, within, call it 90 days. But it takes 18 to 36 months end to end, depending on resources. Okay, so let's talk about that last step, which is, okay, but how do I get all the benefits of a more modern technology platform, including our core that I mentioned early on in my material? Well, there is a way to do it. And again, this is stealing directly from what the larger financial institutions have done. When you look at the typical setup for a technology stack for financial institutions, they use the same vendor for most of their technology. Okay, so the core, what we think of as the core, which is your system of record, your ledger of accounts, where you connect to payment systems, maybe your general ledger. Okay, that's sort of, you know, at its core, pardon the pun, what a core really is. The core has grown conceptually via the same vendor to include all this peripheral technology. Okay, payments, statement rendering, account opening, bill pay, mobile, online, treasury management services. I could go on and on. This is what we call these peripherals. Okay, this is the stuff that banks complain about, that 80% who are dissatisfied. This is where the complaints are, is that this customer-facing technology is antiquated and you're held hostage. There's not innovation going on. So there is a way to break through that without introducing excessive risk into the process. This is what the larger banks do. It's a three-step process. The first step they go through is they put in what's called an integration layer, also known in some circles as quote-unquote middleware. So integration layer is a piece of software that lives in between your core and third-party applications and creates the ability to connect with third parties. Where do we get it? Some of the larger banks have the resources internally. They just built their own. Okay. For the smaller financial institutions who don't have the resources to build their own, your core provider may in fact offer an integration layer. It's not going to be cheap, right? Because we mentioned at the beginning, these are expensive old technologies, but it is there. And the benefits you derived from unifying your data, driving better customer experience, driving more efficiency, now's the time to go spend some of those benefits. So go spend the benefits on an integration layer to your core, which could come from your existing core or may come from a third party. There's any number of third party companies who all they do is build integration to companies, and they're remarkably affordable. Okay, so that's step one. You put this integration layer in place. Okay, step two is then you look at each of the peripherals that you have and ask yourself, do I like what I have? Is it working well? Is it modern? Or is there something better out there that's either better functionality, cheaper, etc.? And as you identify potentially better alternatives externally, you go replace your old piece with a new third-party piece that's integrated in with your core through this integration layer. And what you're left with, if you compare this to this, is you now have the ability to strip down your core to really just the core, the ledger, the account ledger, connection to pay systems, and you can do this one step at a time, right? You don't have to rip out your old online banking system. You can put in a new one, connect it in through your integration layer, test it out, what we call sandbox it, and then put it in place and then move on to different things. So it's a slow, methodical process as opposed to this rip and replace thing. And by the time you're done and your core is just your core, replacing the core with a modern, much less expensive, better contract, fully open architecture, you own your data core is a very simple process because your core has been stripped down to more fundamental functionality, and you can literally run that new lightweight open architecture core in parallel with what you currently have and not switch over until it's clear that everything works. Okay, so that's a lot of information to cover in 38 minutes or so, but hopefully the density of the information doesn't take away from the overriding message, which is that if you take a methodical step-by-step approach that starts with data, uses that data to improve how you engage with your customers and drive process automation internally, and then go through a step-by-step test and replace process with your existing technology, you can get over the course of, let's call it a couple years, you can get to the place you want from your technology perspective, that allows you to leapfrog the big competitors because it's going to modernize you while arming your bankers with tools that really transform the way they engage with your customers. So with that, I will stop here and take some questions.
All right, thanks, Ray. Appreciate it. Great presentation. We do have a few questions. We're almost at the end here, but we'll go through them. We have a few. Ray, one question is from a member who mentioned or who stated that you mentioned artificial intelligence during this presentation, and he would like to know if you can speak more about what that exactly entails and how and provide examples of how community banks can use that effectively.
Sure, that's a great question, right? You know, and I'll start by saying what artificial intelligence is not, at least in the community financial institution space. It is not arming a computer to replace people's jobs. Although if you want to go down that route, there are certainly plenty of sort of chat bot type applications that use artificial intelligence to create a digital help desk. When I think about artificial intelligence for community banks, it's really mostly machine learning, if you will, that looks at customer behavior, looks at data, transaction data, account opening data, et cetera, to learn how customers are acting in order to be smarter about how you engage with them than you could be on your own. And to help you automated processes. So it is the two things that I mentioned. You know, the things like the attrition analysis. You know, which that's a good example of artificial intelligence, where the machine goes through and looks at how the customer's relationship with the bank has changed transactionally, which digital tools the customer's using, et cetera, to predict risk of leaving the bank. And then the false flag problem, you know, in BSA, looking at past activity and learning from how a BSA case officer clears false positives, so that over time the machine can learn how to do that, which frees up the case manager to only focus on the real suspicious examples. Those are the kinds of things I'm talking about when I talk about AI.
Okay, thanks, Ray. This next question is from a member. They've been looking at bank technology firms like yourself to replace their core, but their board feels it's a really risky proposition. So the question is, how do your customers get past that fear?
It's a great question. Look, you know, the math speaks for itself, right? That 4% number, right? You know, people rarely change their cores, and so to get to a place where you're going to be comfortable working with a modern core, we don't see a shortcut. We think that the journey that we described, where you start working with that vendor, and this is certainly what our customers do, when they start working with us and they start focusing on this data unification and using some of our customer insights tools in our AI and our BSA AML, what that does is over a 12+ month period, it creates a tremendous comfort level with the bank, with us as a vendor, and it paves the way for it just makes the whole process of eventually migrating to, in this case, our core, because we have a core, makes the migrating to our core a much less riskier conversation than talking about the front end. Hey, you know, 18 months to 2 years from now, we're going to switch to your core. That's the way we do it. It's that sort of step by step journey.
Okay, Ray, thanks a lot. And last question, under your approach, one of our members stated, under your approach, is a replacement of the core at the end absolutely necessary?
It's a great question. I could be flippant and say, no, you can continue to overpay for ancient technology with bad contracts. But, you know, realistically, no, I suppose it's not. If you follow that process and you've gotten all of those benefits internally, and you have created this better customer experience, you could keep your old core and just relegate it to being your ledger of accounts and all of that. I'm just not sure it makes sense to do so, because replacing it with a more modern core will reduce your cost, give you more flexibility, give you full ownership of all the data that's inside that core, et cetera. So the benefits of ultimately migrating to that core are such that it is, I think it's a vital last step in the journey.
Okay, got it. Well, thank you, Ray. That concludes our session. That concludes all our questions that have come in today. So we really appreciate you presenting to us. Just want to let the listeners know our next session is October 15th. The presentation will be regarding asset liability management strategies and what to consider at this point of the interest rate cycle, and that would be conducted by Scott Hildebrand. He's from Sandler O'Neill. So thank you everyone for attending again. Thanks, Ray. Appreciate the great information. And if anyone wants to get any additional information, you could please just feel free to contact your home loan bank relationship manager, or contact Ray directly. You see here the email is here at the end of the presentation. So thank you very much, and have a great day, everyone.